5 years ago, many investors thought that the trade desk was their ticket to millions. Sadly, since then, it has offered zero returns. They recently dropped 53%. So is it an obvious buy? Is Amazon eating the trade desk for breakfast? That's exactly what we're going to be covering in this video, along with how the business makes money, why the stock has dropped, their AI opportunity, and my valuation. Let's get straight into it. So is the trade desk a great buying opportunity? Down 53%. To know that, we need to know, what does the trade desk do? So the trade desk is a demand side platform, or a DSP, that helps advertisers buy digital ad space. It uses data and AI to optimize campaigns across connected TV, websites, audio, mobile apps, and more. The trade desk enables brands to reach targeted audience efficiently outside closed ecosystems like Google, Meta, or Amazon. Now, most YouTubers would just read this out to you and hope that you understood the business, but I'm going to go a little deeper than that and explain it visually. Because, like Warren Buffett said, never invest in a business you cannot understand. Know what you own and know why you own it. So the trade desk operates in something called the open internet, and I'm going to basically explain how the trade desk functions. Nike, the advertiser, says, we want to advertise to young adults who like tennis. Let's say they have a few adverts prepared already. Now this is where the trade desk comes in, a demand side platform, or a DSP, as you can see here. Just remember that acronym. Essentially, Nike goes to the trade desk and says, here are our goals for our advertisement. This is our budget. This is our target audience and our bidding strategy. Now with the bidding strategy, we'll get to that in a minute. Now on the other side of the spectrum, there are the consumers. You see we have one here at a cafe on his laptop, another one on his phone, and the last one watching tennis on the television. And there's thousands of publishers that have ad space. So right now, the guy on the laptop is on Yahoo Finance, let's say. And the guy on the phone is on Spotify with his headphones on, listening to a tune. And the guy down the bottom is obviously on his TV watching some ESPN, watching the tennis on ESPN. These publishers have unique data for each one of their current users, and they've collected this, using various things like cookies or other ways. For example, location data. This guy's in a cafe. Yahoo Finance knows exactly where he is. This guy's listening to music and they know what songs he's listening to. So based off the songs, they might be able to gather a mood and therefore sell them something in particular. But this data the publishers have, and they can use this data to sell ad space. But to do that, they need the supply side platform, or the SSP. When it comes to supply side platforms, a good example of one is OpenX. Now there's many supply side platforms. This is just one of them, but we'll use OpenX as an example. Essentially, publishers send us the consumer data. They set up the listing based on the demand, audience, and ad format. So Yahoo might have the ad format that I showed you earlier, those kind of adverts down the side of the page, whereas Spotify obviously have audio adverts, and ESPN is more likely to have like a video kind of advert. So the audience, the demand, the ad format all essentially allows the supply side to set a minimum bidding price and kind of sell the ad space. They obviously afterwards report back to the publishers with the analytics. So they are useful to the publishers, whereas the trade desk, the demand side platform, is useful to the advertisers. So Yahoo put this up for sale, Spotify put their ad space up for sale, and ESPN puts their ad space up for sale. Now comes the real-time auction, where the trade desk makes its decision on what it's going to buy using an AI platform that they've developed called Koa. Now, obviously, this uses inputs such as audience geography, site, device type, performance, ad format, and obviously the bidding strategy that was selected by Nike. And this Koa platform decides what the trade desk will bid on. So they've seen this Yahoo ad on the website and they think this doesn't fit our advertisers, so we're not going to bid on that. Same thing for Spotify. This doesn't fit our advertiser, but obviously the tennis player watching ESPN, the trade desk places a bid on behalf of Nike and wins that bid. So therefore, the Nike ad gets shown to the user. Now, astonishingly, all of this happens within 1 second. To have minimized the time it takes to show an advert to less than 1 second is really incredible. Going through this entire process is a madness in less than a second. And this happens literally as soon as, for example, somebody was to enter a website. That split second where the ads are loading up, this is the process that is happening. After this process is done, the trade desk reports back to the advertiser Nike on the impressions, clicks, conversions, cost, and ROAS, which is return on ad spend. All of this is very useful information for Nike, and Nike really relies upon this. During this process, how does the trade desk make money though? The trade desk will take a percentage fee of the total ad spend, usually between 7 and 10%. This is digital advertising in the open internet. But of course, there are other methods of advertising, and one is the walled gardens. The walled gardens being Meta, Google, Amazon, and these little challenger gardens that you see the logos for down here. You can see the open internet here, which kind of intersects between all of them, has its own space, but also intersects with Amazon, a lot more with Google and barely with Meta. Now, what do I mean by walled gardens? Well, this is a term that you'll probably hear quite a lot if you are a trade desk follower, and essentially it just means that the platform owns the demand side and the supply side. So obviously Meta owns the demand side and the supply side, so there is no bidding. Meta just automatically sorts that out for you. So this is the demand side, the DSP, and there's the supply side. There is no real-time auction. The advertiser goes directly to, let's say, Meta instead of the trade desk. Meta then just instantly distributes it to its various sources. Let's say one's Instagram, one's Facebook, and it selects based on the user and the data it's collected on the user. So those are walled gardens, and I will go over why the trade desk thinks it has an advantage over walled gardens a little bit later. But here's an internet advertising map just to kind of give you grips on what is and isn't in the open internet. Obviously, you've got the walled gardens over here, X-Ads, Meta AI, LinkedIn, TikTok, Snapchat. Then you've got somewhere in the middle, YouTube, Amazon ads, native content up the top. Then you've got the logged in internet down here. So, you have to log in to Netflix, you have to log into Spotify, HBO Max, all that type of stuff. And then obviously the open internet down here. Now, in terms of what the trade desk does, they are in all of this realm down here, just not the walled gardens. So moving on, why has the stock dropped recently? The main reason is disappointing forward guidance. The trade desk's Q2 2025 revenue grew 19% year over year. This is a massive deceleration from Q2 2024, where it was growing at 26% year over year. Now, obviously, every company starts to decelerate as they become larger, but this, for investors, seemed like quite a large deceleration, and their guidance was also pretty bad. For Q3 2025, the company guided for a revenue growth of at least 14% year over year. Now, 14% isn't bad, it's pretty good for the average company, but the trade desk was seen by investors as a particularly fast growing stock, and it has been over the years. Now, if we have a look at here, you can see Q2 2023 to Q2 2024, there was that 26%, then the 19%, and then now you can see that 14%. This is going to be Q3 as per the guidance. Now, management cited tariff uncertainty for this. I'm slightly skeptical about that. I mean, I kind of understand they're saying that the advertisers are under tariff uncertainty and therefore they don't want to advertise as much. I'm not 100% convinced by that. I guess it does make sense in theory. I just don't know whether it's the pure reason for this slowdown, because we also see that margins have also declined. You can see down here the adjusted EBITDA margin in 2025 Q2 is 39%, whereas in 2024 it was 41%. So investors really weren't happy with the slowing revenue and the margins declining. You can see the 6 months ended 2025, 37%, 6 month ended 2024, 38%. Now, when it comes to the trade desk, it was trading at a premium already. We have to admit that. The PE before earnings was 105, and after earnings it dropped to 65, which is still a high PE ratio. 105 was here, that's 65. So, over the 2-year time period since 2023 Q2, it was trading at 300 PE ratio, and that barely came down in 2024 either, sat at around a 200 PE ratio. And because of this, this is what I always say about multiple compression. Multiple compression can lead to the stock price just being completely flat for 5 years. Now, lots of people would say, "Oh, yeah, but it hasn't gone down." Yes, but you've missed out on the market returns for 5 entire years. Multiple compression really is a bitch, and I warn people about this when they invest in stocks like Palantir. This was trading at a 250 PE ratio, and this is what happens: 5 years of absolute flat growth. Now, on top of that, we have slightly more bad news for the trade desk. You have Amazon entering the game and saying, your margin is my opportunity. This is the classic Jeff Bezos Amazon approach to every business they really enter in. They've completely slashed fees. Amazon Demand Side Platform, or DSP, has cut tech fees to as low as 1% on programmatic guaranteed deals, far below the industry norm of 7 to 15%. So they've gone in really, really low. And from the agencies, they've reported incremental spend shifts to Amazon for some of their exclusive inventory, better pricing, and access to Amazon's user data. Obviously, Amazon has a very broad inventory access, and so does the trade desk, but typically Amazon never used to have these third-party supply deals with people like Hulu and Samsung TV Plus. So now they're providing adverts to Samsung TV Plus and Hulu, not just Amazon Prime and their own kind of ecosystem. This has also put a lot of investors off the trade desk with increased competition. This could be the reason why some of the margins are dropping, especially as Amazon is just coming in with that 1% and potentially, eating away at that. But what do management say about all this? Well, management say that they still have the advantage. And this is what I was talking about when it comes to walled gardens. The trade desk management believes that walled gardens are biased because they own both the ad space, the supply side, and the platform used to buy the ads, the demand side. This creates a conflict of interest because a walled garden's main goal is to sell its own ad inventory, which can lead to it prioritizing its own interests over what might be the best for the advertiser. The trade desk, on the other hand, sees itself as neutral because it doesn't own any of the ad space. Its purpose is to help advertisers find the best and most effective ad placements across the entire open internet, no matter who the publisher is. So essentially, they are saying that they have the advantage over these platforms like Meta, Google, and Amazon because they do not have a conflict of interest. They are not trying to fill their own ad space because they don't have any ad space to fill. So a company like Amazon, for example, might try and fill its Amazon Prime video slots before trying to fill someone like Samsung TV or Hulu's advertiser slots, because the Amazon Prime Video slots make them more money. So therefore, they are biased. So this is why management say they still have the advantage, and they think that long term, advertisers will choose the trade desk over some of these walled gardens. Now, I'd like to add that at the minute, I think that the walled gardens are offering a better return on investment for a lot of the advertisers, and that is why probably the trade desk is struggling a little. But this, in my opinion, is due to AI. And, Meta really has gone to town with this. Their earnings have expanded so quickly because of their AI advances recently, and they've created huge AI efficiencies because of this. And luckily, the trade desk has said that they are willing to invest way more into AI. So they're going to focus on innovation. The company is heavily investing in its AI-powered platform, Coq AI, as well as other innovations. The company is heavily investing. I got a matcha. Tastes like shit. Focus on innovation. The company is heavily investing in its AI-powered platform, Coq AI, as well as other innovations in CTV, retail media, and supply chain transparency. CTV is basically connected television, so Hulu, Samsung TV, that kind of stuff. This could be very bad or very good for the company. And, these are two approaches that people might have. It will be bad because it will mean they will increase their R&D spend percentage, which, by the way, is already trending up. I think it's trending up to 17% year over year now. It was at something like 15 or 14% the previous year. And, this is adding to their margin pressures at the moment. Is the further R&D spend just to keep up with the competition from the big dogs? This is what I'm asking, because if the further R&D spend is just to keep up with the competition from the big dogs, then their margins won't expand because everyone else will have a very similar technology to them. With the R&D spend, they really need to get a significant advantage. And with Meta, Google, and Amazon all investing heavily in AI with huge amounts of backing, I think that the trade desk might find it a little bit difficult to compete with such large AI platforms with money bags to support them. However, on the good side, it could re-accelerate growth due to the AI capabilities and efficiencies. We could see that, AI completely benefits both the walled gardens and the trade desk at the same time, and both of their margins rise. And this is the other side of the coin where, everyone gains from AI and there's no losers in the space. We're seeing this obviously currently with Meta, where their efficiencies have gone through the roof, their earnings have shot up because of their AI advertising capability, and this most likely is what's going to be coming to the trade desk. So if I was to lean towards a side, I'm actually more bullish. AI will create more value for their customers, for their advertisers, and the trade desk will be able to bring in more revenue because the advertisers will see more value in spending more money as they are getting a better return on their investment. So with all this taken into consideration, I'm going to use my EPS growth calculator to see whether the trade desk is trading at an attractive valuation after its huge 53% drop. And now, before we do this, we need to remember that for Q3, the company guided for a revenue growth of at least 14% year over year. This does take into account buybacks. I've given them a buyback estimate of 0.4% per year. They are doing very little buybacks, and I think they are still diluting as well mildly. From now, I'm giving them a revenue growth rate of 17% year over year. In my opinion, this is actually really bullish. This takes into account my opinion on AI boosting their revenue growth, especially as their revenue growth is dropping down to 14% at the minute. 17% revenue CAGR, I think, is quite bullish. So if you're on the bullish side for the trade desk, this is the valuation for you. Moving on, the net income margin. I've moved this up to 17, bearing in mind it's currently at 15.57. So I have said that the net income margin will increase. This is just the earnings margin. Net income and earnings are the same thing. So this is just the earnings margin at the end. It's currently trading at a 65 PE ratio. So under a 65 PE ratio, if it were to stay here, which is very high PE ratio, by the way, it would offer you 19.56% year over year, which is, definitely an outperformer by far. If it were to trade down to a 60 PE, you're only seeing 17.68%. Now, I think what's more realistic is a 55 to a 45 PE ratio. This offers between 15.6 to 11.9% return from here. So personally, I'm not going to be investing in this. I do believe it would probably sit at about a 50 PE ratio, which is somewhere in between here. And considering 55 is a 15% return, and I'm looking for 15% returns, anything in the 50 PE range is less than 15%. But look, if you're insane and you believe that the PE ratio will increase, then obviously you're looking at stupid, crazy returns. But let's not even consider that, because I really do not think the PE ratio is going to increase from here. Now, if you want to look at a base case for the trade desk, you'd give it a revenue CAGR of 14%, which is what it's currently growing at. Net income margin of 15.5%, which is the current earnings margin, the current net income margin, and you'd give it a buyback estimate of 0.4, which is kind of what it's doing at the moment. With these assumptions and it trading at its current PE ratio of 65, you're going to get a 14.46% return from here. Now, this doesn't hit my threshold of the 15% return. It's also a crazy high PE ratio. To predict that it's going to be trading at this higher PE ratio in 5 years' time is, in my opinion, very, quite bullish. So I'd be looking down more into this range and the 55 to 45 range. And personally, that's just not offering me a good enough return here. 6.45, 10.75%. Like I said, I am quite bullish on the company, but even then, in that 55 PE ratio to 45 PE ratio range, we're still not really getting the returns that I'd want to see. Subscribe to the channel if you enjoyed the video. Bye-bye.
I'm hopping out Ferrari. My house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she treated me kinda